Okay. Okay, please turn onto the slide, record the slide. Okay. Hi, my name is Vin. Today we will present the core project that we've been working on. Firstly, let me talk briefly about the outline of the presentation. We are going to have an introduction about the case, about the company that we work for. Then it will be the cost structure of the company and its current performance analysis to know whether that they are profitable or not. Next, there will be an analysis of some solution provided by the CEO of the company. And final things are conclusion and recommendation for the business to apply. Before we start, I want to present to you our team member. The first one is me, Vin, V, and Patrick and Michelle. So we're going to begin with the introduction. The company that we will present is Marathon, which is a flash drive manufacturer. Marathon wants to achieve the net income $150,000 for this year 2019. However, the current expected sales is 115,000 unit. So we will have some analysis to know whether that expected sales Marathon can achieve the target income or not. Then the presentation will give some recommendation for Marathon to apply. Let's begin with the cost structure of the company. We have variable costs that are changed in total proportionally to the change in the related level of activity or volume. Variable costs contain direct material per unit, direct labor per unit, sales commission per unit, and advertising per unit sold. On the other hand, fixed costs are costs that remain unchanged in total despite change in the related level of activity or volume. In this case, we have advertising, miscellaneous selling expense, a fixed salary, supplies, miscellaneous general expense, and sales salaries. And finally, mixed costs have both variable and fixed component, comprise other factory overhead. After all calculations, we have the total variable cost per unit is $14 and total fixed cost is $500,000. Next, with the expected sales is $115,000 a unit, Marathon will get minus $40,000 as the net income, which means that the company will get lost if the expected sales do not change. In order to achieve $150,000, Marathon needs to sell 162,500 units of product. In the bottom table, there are contribution margin per unit, contribution margin ratio, and the break-even point of that I calculated. This table present the next table present my calculation in detail to achieve the target in net income. And to provide more detail for the head of Marathon to make decision, we come up with the Marathon income statement in contribution margin format. Next, my teammate will present to you the analysis of all of the suggestions from the CEO.
So one of the first suggestions was having an increase in sale or increase in price, and in turn it would decrease the sales volume. So by increasing the price, the new sale it would decrease the sales volume by 30%. So the new number of units sold would be 80,500. And then in turn, the total sales will be 1,666,350, with a variable cost of 1,227,000. And by taking contribution margin away, by taking them both away, you get contribution margin of 539,350. And after taking fixed costs, you are left with net profit of 39,350, which is a massive increase compared to their original figures. Suggestion 2, well, they wanted to increase sales salaries of employees, which would in turn increase the sales volume of the business. So the number of units will be sold will be increased to 149,500. Selling price would stay the same. Variable cost will also stay the same, and contribution margin again will also stay the same. So sales would become 2,691,000. Taking away variable cost, 2,993,000 would give us a contribution margin of 598,000. And then after taking fixed costs, net profit became 49,500, which is about a 90,000 increase from the original net profit projected. Suggestion 3, it was to redesign packaging of the product. And by doing that, it would increase direct materials by 50 cents per unit. Also increase fixed factory overhead costs by 3,000. And then in turn, it would increase sales volume by 15%. So the new variable cost per unit would increase by 50 cents to become $14.50. New fixed cost would also increase by 3,000. And the new number of units sold would increase to 132,250. And then the new selling price would stay the same. And then the projected sales for this would be 380,500. Taking away variable cost would be the contribution margin of 462,875. And then the fixed cost taken away from that again, it would give us a net profit of negative 40,125, which is about the same as what our original projected was, which and would not suggest doing this as a suggestion. Suggestion 4, it was the project manager suggested to increase the quality of the units and then in turn increase the price of the units. So the variable cost would increase by 20%. Fixed overhead would also increase by 10%. Sales price would increase by $3 per unit, and sales volume would increase 20%. So this increase would increase the new variable cost to $16.80. And then the new fixed cost would become $570,000. And then this new selling price would be $21, as it was increased by $3. Sales volume was increased by 20%, which becomes 138,000. So the sales of this suggestion was 2,898,000. Variable cost of 2,318,400. With a contribution margin of 579,600. Taking away fixed cost, the net profit would become 9,600. So this was another improvement, but compared to A and B, it wasn't the same. And now we're going to move on to the conclusion.
To conclude, our presentation has analyzed the cost structure and the current situation of Marathon. Also, the presentation has also pointed out the KPI of sales for Marathon to reach the target income, which is $150,000. Moreover, the profitability of suggestions from Max are carefully examined. After the analysis, the next part I will recommend some possible solutions and the most profitable one for Marathon to get back on the track and improve the business. As being shown in this figure, it's clear that Marathon can use either solution A, B, or D to avoid loss and gain profit. In contrast, solution C will occur the loss, approximately about $40,000, for the company, those marathon should not apply the solution C. Besides, within three possible solutions, solution B seems to be the most profitable suggestions, which will bring for marathon about $50,000 benefit. This is the end of our presentation. Thanks for listening.